You have probably heard traders say things like pride is hunting liquidity or smart money is going for stops. But when you open your chart, everything just looks random. No arrows, no labels, nothing obvious. That's not because of liquidity is some mysterious concept. It's because most traders don't know what they are actually supposed to be looking for. Liquidity doesn't announce itself on the chart. It doesn't come with an indicator or a signal. It sits quietly around obvious highs, lows, and areas where traders tend to place their stop losses. If you don't know how the market behaves around those areas, you will miss it every time. Once you understand where liquidity sits and how price reacts around it, a lot of things start to make sense. You start to understand why price suddenly spikes into a level, why it runs a high or low then reverses, and why certain moves feel aggressive or intentional. In this video, I'm going to break this down step by step. First, I will show you what liquidity actually looks like on the chart. Then I will explain how to mark these liquidity zones perfectly without overcomplicating things. After that, I will show you how to use this liquidity as a framework for high probability trades. And finally, we are going to walk through a real chart example so you can see exactly how this plays out in live market conditions. And also, something I'm going to give you guys as a bonus is I'm going to give you guys a trick that will put all these liquidity concepts together and make it very easy for you to work with. And guys, this video actually took me a lot of time and effort to put together. I would really appreciate if you can go down and hit that like button and also subscribe to the channel. Yeah, and if you want the slides or the screenshots that I will be using, I suggest you get it. Click the link in the description to check it out in our free Telegram channel. Just type out this title of this video. You should be able to see it there. Just search it out. Yeah, and I'll see you guys around. I'll see you guys inside. So the first thing we're going to talk about here is liquidity. What is liquidity? When you hear the word liquidity, we are basically talking about stop losses, right? Liquidity is simply where orders are resting, and most of these orders come from retail traders placing stop losses in very predictable places. So liquidity is created by traders doing the same thing at the same areas. For the market to move, we need liquidity. If institutions want to move money, they need liquidity. Example, let's say maybe a huge institution want to sell BTC, okay, want to buy and sell BTC, they need counterparty, right? They need someone to sell that BTC. They need someone that will buy that BTC from them for them to be able to execute that trade. And these people are executing enormous um, orders, right? Their trades are usually huge and they need counterparty, right? You need someone that will be willing to buy. So this your stop loss. When you place a short trade and you place your stop loss above a high, what you're basically saying is you're telling you, okay, let me try to identify this. And let's say you place a short trade at this point. What you're basically saying is that you're telling your broker to trigger you here. Okay, no, this actually be a buy. Okay, so in this case, let's say institutions want to sell BTC. This is not BTC, but let's just call it a BTC. So institutions want to sell BTC, and at the same time you want to buy BTC, and you are putting your stop loss at this point. Let's say you are putting, excuse me. So let's say you put your stop loss at this point and your take profit at this place. So what this your stop loss actually mean is that you are basically saying that you're basically telling your broker that I want to buy BTC at this price, and if price is going to trade all the way down to this place, you want to close your orders at this. You want them to automatically close your orders at this point. So um so so what price is going to do, or what these people are going to do, is that they are going to try as much as possible to trade just low enough to trigger your stop loss, then trade to your intended direction. So if the price, even though the price is poised to go trade higher, what they are going to try to do is to trigger your stop loss. So when they trigger this your stop loss, they have get liquidity to move price to that intended direction. So don't worry if this doesn't make sense for you, you don't really need it. It's not what makes money in this market. So let's actually talk about what makes money, right? What you're going to be needing to trade effectively, right? So something you want to take note of is that the market doesn't move randomly. Like large players need liquid to enter the market and exit position, right? If you want to buy something, you need someone to sell it to you. If you want to sell something, you need someone to buy it from you. And what the market usually do, what institutions usually do, they try to convince traders through inducements to want to for them to want to sell to them or want to buy to them. And how they know all these things? By you placing your stop loss at obvious levels, because of it is a normal retail logic that place your stop loss above highs and your stop loss above highs and above lows, or above support and resistance. So these obvious areas as liquidity resting zones, liquidity usually rests at this point, and all these areas trend line equal highs and equal lows. So liquidity usually rests at those areas, right? Because of many traders are looking to execute something there. They're either looking to sell their position through their stop loss, or you looking to and so when they sell this their position, they flood the market with liquidity, right? So the problem is, enough of this all this stuff. The problem is, how do you know liquidity? Well, what most mentor will teach you, they will teach you basically that liquidity is basically any high, anytime you see equal highs and equal lows, that's liquidity. Or anytime you see trend line liquidity, or anytime you see trend line, you should expect price to come and take out those liquidity. But in most cases, sometimes price, how do you know which one price is going to take? So they just give you listen to work with, but how will you know which one price is going to take? And it's not every time a price is going to take out all the liquidity, or even in a trend line, so in an equal high and equal low, sometimes price will not even take it out. So how do you need it to? How do you know need to know? Because of, if you decide to say, okay, this is going to be liquidity, price is going to take out this liquidity. What about this one here? Okay, what about this one here? What about this one here? Which one are you going to pick? And that's when having a systematic or mechanical approach to trading this or viewing liquidity comes handy. Okay, when it becomes effective, you need to have a mechanical approach. If not, you're going to be guessing. You're going to be just doing taking trades based on how you feel, and that is actually a recipe for failure, right? So what I'm going to give you guys is right. I told you guys I'm going to teach you guys what liquidity looks like. I've already explained all these equal highs and equal lows. Okay, let me just try to draw it. This is not what I want to rush to the main topic. But basically, there are three types of liquidity. We have swing high. There are three forms of liquidity. Take note of this. There are three forms of liquidity. And these three forms of liquidity, there are actually three types of liquidity and three forms of liquidity. And I'm going to explain the three types of liquidity as we progress. But for now, just know that there are three forms of liquidity. We can either have an equal high, we can either have a swing high, basically a swing made up of three candles. Example is this is a swing high, this is a swing high, this is a swing high. So we can also have, or we can have an equal high. We can have an equal high like this. So this is where price creates relative equal highs, right? So this is a case where price creates relative equal highs. This is called equal highs and equal lows. So liquidity is usually sitting above this point. So once again, why is liquidity sitting above this point? That's because of it is a normal, is a usual method. It's a usual concept, or that's what is actually taught, that you should place your stop loss above swing highs, right? So there are traders that are above support and resistance. So this is actually support. So traders are going to see this and okay, price respected this level the first time, respected the second time, respected the third time. So they're going to be like, wow, this is a strong area of support. And what they're going to do is they're going to place their next entry at this point, put their stop loss just above the support, and take profit anywhere. So smart money knows that this is what they're usually doing. So what they're going to do, they're going to, even though the price is poised, even though the trader is right about their analysis and they know that the price is going to trade lower, what institutions are going to do is that they can't just trade lower. They need liquidity to trade lower, and they're here to make money, right? So what they're going to do is they're going to trade just high enough to take them out and continue to the downside. So that's what happened. Now, the third form of liquidity is trendline liquidity. Now, this is in case when price is trending, forming series of this and this and this. And now, if you have to draw your trend line, you can actually see your trend line like this. So, you know, trend line is actually a popular concept in trading. So, how does this trend line concept works? Basically, what this trend line, okay, my mic is done. Basically, what this trend line emphasizes, or the rules, what they're trying to tell you is that when market forms this trend line. When you have your trend line, basically you have to wait for price to retest the trend line, you buy. Wait for it to retest the trend line, you buy. Wait for it to retest the trend line, and you buy. So that's the concept of trend line trading. So basically, based on what I taught you, what traders are going to look for is they're going to look to enter at this point, put their stop loss just up below, and take their take profit. And they're going to keep doing this thing. They're going to keep doing this thing. And so, as always, smart money these days it has become a normal concept. So they are aware of this this popular way of traders. They are aware of traders are always looking to buy at that trend line. So what they are going to do is, even though the price is poised to trade up, what they're going to do is they're going to trade low enough just to trigger their stop. When they trigger this stop, I want you guys to understand this thing. When they trigger this stop, what actually happens? Well, when this their stop loss hits, right? So they have decided to sell. They have agreed to sell their price, to close their position at a lower price, right? There is this decided because they bought at this point. Just imagine you bought an Apple or something else at this point. I'm trying to make this video to accommodate newbies, right? So just imagine you bought an Apple or something like that at this point. Let's say $1. So you said you just, or let's use iPhone. Let's say you buy an iPhone for $100. Say just say $100, and you say you want to sell the iPhone when it trades to $500. But if the iPhone price keeps tanking, you don't want to lose so much money, so you want to sell. You just want to sell your iPhone at $90 and just take a $10 loss. So this is exactly the definition of this thing. So what smart money is going to do, they're going to try to trigger you, and they're going to trade just low enough to trigger that, to trade all the way to that $90 mark that you set. And when they trade to that $90 mark, you have literally sell your iPhone at $90, which is at a cheap rate to them. Then they'll now finally trade to the intended direction. And then how do they know that this is the price you are looking to sell it at? How do you know it? And that's because of most traders put their stop loss at obvious areas, because this is a normal concept. It's a popular concept, trend line. So everybody knows that people are looking to sell at this way. So they spike it down enough to just take them out. So that's the three forms of liquidity. We have swing high, equal highs and equal lows, and trend line liquidity. Now all these grammars are not really relevant. It's not what makes money. Now let's talk about what actually makes money. Because we're going to talk about in this video, once again, I'm going to give you guys a very easy way to put all these liquidity concepts together and view it in a more systematic and mechanical way, right? And I'm going to show you guys how to take a setup. How do you take a high probability setup using this liquidity concept? You're going to learn a lot. And these my videos are not usually structured, so but if you watch through the video, you're going to learn a lot. Now, next time I want us to talk about is let's talk about this liquidity and also talk about the types of liquidity. Let's put this thing up well. Okay, so let's talk about the types of liquidity. And okay, let's now talk about the types of liquidity. Uh, okay, so let's now talk about the types of liquidity. So every swing high or swing low is basically liquidity zone. This is liquidity, this is liquidity, this is liquidity zone. Liquidity is now on this place because of their traders are looking to play, they are placing their stop loss here. But there are ones that are more of interest to the institutions. So our goal of this video is not to it's not how to find liquidity zones, but rather how to spot key areas that price will likely not take out, and trade to. So that's our goal. We're looking for how do we spot um, key liquidity zones that price will likely take out, not take out, or trade to. So that's the three this thing. Because we said every swing high and swing low is a liquidity. So that's the goal of this video. And to do this, we need to be able to view liquidity in a systematic way. We need to have a systematic approach to viewing this liquidity. So what I'm about to teach you guys is actually a mechanical approach that's that's to viewing this liquidity, and this is going to make this whole liquidity concept very easy for you to grasp, right? So for that, the first thing we need to be able to do is to understand structure, our main structure, right? Swing structures. And well, let me try to draft out swing structure now. Alright guys, so these are the types of liquids we have, right? Obviously, this might not be what you are used to, or it might not be the industry standard, but I want you guys to take this thing. If you can visualize this thing, if you can visualize liquidity like this, you will have the best trading, the best you're going to be trading. This your liquidity concept will be very clear for you, right? So this is actually something that learned from someone, and I think that's the best way to visualize it. So what we have here, first of all, you need to understand your swing structure, and this is basically okay. Before we talk about your swing structure, let's try to explain this liquidity. So as I told you, there are three types of liquidity, right? So the first liquidity you can see here is an inducement liquidity. So what is this inducement liquidity? Let me try to explain this. So these, in some cases, what smart money usually do is that they trade close to the key level. So when they trade close to the intended demand zone, they are going to try to move price up. So when they try to move price up in a bullish scenario, obviously, this thing will trick traders into start trying to buy from this demand zone, because traders are going to see this and say, okay, the market is now reacting from this place, so they will try to buy off from this point, and then price finally goes down more to tap into the main demand zone and expand higher. So this is what we call an inducement liquidity. So this is one of the first type of liquidity. It's called an inducement liquidity. It tricks trader into thinking that the market is now ready to go to the intended direction and finally got taken out. So why is it an inducement liquidity? So because you need to be able to differentiate it. It's an inducement liquidity because of one, it didn't actually break structure. Two, it didn't, and it is aligned above this key level. Just calm down, this is going to make sense. And the next type of liquidity we have is called structural liquidity. And this is actually, let me try to screenshot this thing. So, and this is actually your higher highs and higher lows. All these higher highs, higher lows, all this in a bullish trend, all these higher all these higher lows are your structural liquidity. In a bearish trend, all these lower lows, yes, are your structural liquidity. So that's it for structural liquidity. And then we have the next type of liquidity is transactional liquidity. Yeah, so this inducement liquidity, I want you guys to take note of it. It's used for expansion. So when price take out inducement liquidity, the next thing you have is an expansion. Now this structural liquidity is used for continuation. Why? Because what price is going to do here now is that price is going to take out this structural liquidity. When it takes it out, it's going to tap into this place and expand higher. Now, this transactional liquidity is used for either retracement or reversal. So why is this? Because when price take out this external range liquidity, this is actually an external range liquidity. When price take out this transactional liquidity, it will be the catalyst. The next step price start doing is to retrace. You see price retracing to either continue the move. Right? You can either retrace to continue the move, or in some cases it might reverse, breaking the structure here. So you need to take note of this thing. Inducement liquidity is used for expansion. Structural liquidity is used for continuation. When price take out inducement liquidity, you get an expansion. And then when price take out structural liquidity, you get a continuation to the move. When it takes out transactional liquidity, in some cases you get a retracement and price will continue to the upside. But in other cases, you get a reversal in some cases, right? So I want you guys to take note of this thing. So now, how do you differentiate this liquidity now? How will you be able, this is your swing structure, because your swing structure comprises the three types of liquidity. In this your swing structure, you have a structural liquidity, you have an inducement, and a transactional liquidity. Now, with whichever one price take out is the catalyst today, you have already seen based on what I explained to you guys, because I told you, as you can see, inducement is for expansion, structural is for continuation, transaction is for retracement or reversal. So whichever one that price takes out, you already know what price you're looking to do. And this low here, this is your swing high, this is your swing low. So this is your protected low. So now you see this. Now you now see the kind of liquidity that is usually not taken out. This is called your protected low. Let me annotate it. So this is called your protected low. So this liquidity, because of I told you earlier, every swing high and swing low is actual liquidity. But there are some ones that price usually take out, some ones that price don't like to take out, right? And some ones that price likes to go towards. So and so that's why I do. So now understanding this thing makes your trading easy. Now you already know that this is your protected low. Why is it your protected low? Because of this is the low that swept liquidity. It swept this inducement liquidity. This one didn't sweep it. In this case, do you see any sweep? No, we didn't sweep any liquidity. So that becomes your protected low. And then this place is your so now that's yeah, my videos are not well structured. I'm sorry for this, but if you watch through the video, you should be able to understand it. And the PDF, the slides for all these things are actually I'm going to be leaving it in our free Telegram channel link in this video. Now, and now this whole place, this so how do you tell the difference between this liquidity? Because if you are seeing it in chat, you might be confused. So an inducement liquidity, it basically have no break. It usually have no break or structure. It doesn't usually break the structure, and it is above, usually formed above a key level. Where a structural liquidity is in an uptrend, is that your higher low, is that your higher low, but in a downtrend, is that your lower, is that your lower low, right? So that's it. So that's how to know it. Why your transactional liquidity is the other part of it, which is that your higher high and your uh, lower high. So this thing is basically your external range liquidity. And when price take out inducement liquidity, you get an expansion. When you take out structural liquidity, you get a continuation. When it takes out transactional liquidity, which is this place, when price takes it out, you get either a retracement, price might retrace and continue to upside, or a reversal. So that's it for this liquidity. Don't worry, I'm going to explain this in with a live chat and everything is going to make sense. We're going to go to a ton of example. But before we go through a ton of example, just so you guys know, I actually started a challenge with my private group. I've been doing this challenge myself, so I decided to bring it and take my mentees along. So what's the goal of the challenge is to accumulate 200k in profit capital for this quarter, right? Each badge, that's what we try to do. To accumulate 200k in profit capital. The last time we accumulated, I did this, the one that I did myself, and all the proof is in this free Telegram channel, is I actually accumulated 560k in profit capital. So I decided to do this challenge, start this challenge again with my private group. So the goal was to accumulate at least 200k, starting with the smallest profit you guys can afford, which is either 5k or 10k. And we started this challenge. The first one we did was last quarter, right? And we were able to, we only passed three profit. We bought the first 5k, pass it, bought another 5k, pass it, and bought the next 25k, and we are trading it. So that's what happened this for that last year. And this year now we have started this challenge again. We started this challenge back in January, and so far so good. We have been able to, we started with a 10k account, we passed the 10k account, put a 25k, pass it, then bought a 50k, and that's what we are trading currently now. But if you join, I'm going to try to um I'm going to, normally I told you guys have to cash up, but now I'm going to find a way I'm going to create a specific plan based on the amount of money and based on the amount of the size of profit you're going to buy. So we're going to trade it together, right? So if you guys are wondering, is this true or is this possible, you can actually check out the proof in my free Telegram channel. Just check the pinned comment or the last few this thing, depending on when you're watching this video, where you can see proof of how all the distance we are doing. Everybody's going around. So that's something you're interested in. If you want to make money, why? If you want to make money while you are learning, I think this is the best way to get mentored, right? So your goal is not to learn your mentor strategies to be able to replicate his results. So that's the kind of kind of mentorship I'm offering. So if you are interested, you can actually send me a DM. I'm very active on Telegram. Then I'll fill you in. If you're a good fit, I'm going to sign you up. Right? You can also send me a DM on any of my social. So now I believe I've explained this thing, but I know you guys don't understand it. But just try to take these screenshots and let's go to each individual trade and try to explain this thing. Now, what do we have here now? Let's look at this trade now. Okay, let's look at which trade are we going to look for now. Let's look at this. Which one should we look at? Now, the first thing you want to do is to try to read your market structure. What do we have here? We have price. We have a high, a low, lower low, lower high, lower low. So lower high, lower low. So now the rest price did not break structure. So notice all this thing. Now let's try to understand what happened here now. Now let's try to mark out our liquidity. First, the first thing we want to be able to do is to mark out our range, right? So we are for you to mark out your range, or the first thing you want to do is to try to spot your protected high or low. So in this case, you're looking for a protected high. So what is our protected high? Is that high that swept liquidity? So in this case, you can see that this is the high. Are you sure this is recording? Okay, yeah. So you can see that this is the high that swept liquidity. This high swept liquidity. So this is our protected high. This is not yet our protected high. We still need other conference, but we want to first mark out this thing. So this is actually our inducement liquidity. Why? Because of price swept liquidity. You see, price created a fake move upwards, then started trading lower. So some traders were looking to sell at this point, thinking that price wants to continue to the downside. So price take it out and expand to the downside. So the next type of, so we have marked out in our inducement liquidity. Next type of liquidity we want to be looking for is our, okay, let's try to mark our range first. Which one is going to be easy for you guys? I think the range is going to be, so I think the range is going to be easy. So what is our range? So from this high to this low is our range. So now we have marked our range. We can actually, let's just draw it with a horizontal distance. So we have marked our range. So now from here we can be able to spot all our types of liquidity that we are interested in. And when price takes it out, we know what price is looking to do next. So what do we have here? We have the first type of liquidity we have spot, which is our inducement liquidity. Why is it? Because of price created a fake move. What the price did there? Price created a fake move. It will lure traders. It we had this push of price, so price started trading lower. So what traders are going to be looking to do, some traders are going to sell at this point. So what the price finally, you give them a little bit of reaction, then stop them out, and then finally trade to the main key level, then break structure downwards. So this first one is called our inducement liquidity. Now the next thing, next type of liquidity we want to mark out is our transactional liquidity, our structural liquidity. So this is basically our higher highs and higher lows, right? So just imagine this price action have not yet formed. From this place, it has not yet formed. So that's what I want you guys to imagine, that from this place, it has not yet formed. So from this place, it has not yet formed. So now, what do we have here? We have this high down to this place as our swing structure. Right. So we have marked out our inducement liquidity, and now the next thing we want to mark out is our structural liquidity. Our structural liquidity is in a bearish trend, is basically those higher, lower highs, lower highs, lower highs. That's our structural liquidity. Those lower highs in a bullish trend is basically those higher lows, higher lows. Let me draw it out. So if it's in a bullish trend, all these lower higher low, higher low, higher low, these are called our structural liquidity. In a bearish trend, all this, I hope you guys understand it. In a bearish trend, all these lower, this is lower high, lower high, lower high are called our structural liquidity. Now the other side of it, which is lower low, lower low, lower, called our transactional liquidity. Same as here, in a bullish trend, all these higher low, higher high, higher low, higher low, higher low are called our our structural liquidity. Why all these ones are called our transactional liquidity. So just take note of it. Right? If this video is confusing for you, watch it a couple times. It needs to make sense. When you ask me a question in the comment section, I'll make a new dedicated video. So now what do we have here? These are structural liquidity in this case, because of, if you were to draw it, you can see what happened here. You have a lower low, lower high, lower low, lower high, and lower low, right? So we have established that this is our structure, our protected low, and this is our inducement liquidity. So since this is our protected low, this low is, this actually a structural liquidity, but is a protected low, and price is likely not going to take it out. Why is it a protected low? Because we have a sweep and we also have a liquidity here. So that's the reason why this thing. But in this case, this next one now, this higher, this lower high is actually our structural liquidity. It's actually our structural liquidity, right? And then the next type of liquidity, this low, this is our external range liquidity, is called our inducement, our transactional liquidity. For my liquidity, I like to draw it with a dotted line. Right, so now, as I explained earlier for you guys, when price takes out inducement liquidity, this is an inducement liquidity price takes, what we should expect is the next expansion, the next leg expansion, of which is what we got. When price takes out inducement liquidity, when it takes out this our inducement liquidity, when it takes it out, we should expect expansion, right? So that's exactly what we got. Now, when price takes out structural liquidity, what we should get is continuation. As you can see, price takes it out. Next thing we do, we continue in line with the trend, right? Now, when price takes out transactional liquidity, the next thing we should expect is two things: either a retracement for price to take out structural liquidity once again and continue to the downside. For price, is what we get is either a retracement or a reversal. If price breaks this low, is a reversal. So that's a two this thing. But whenever price takes out transactional liquidity, that's the catalyst for the retracement or sometimes a reversal. Now let's try to keep working this thing down. So let's say price takes out this transactional liquidity. The next move is going to be it is going to be retracement, sometimes reversal, but let's just keep reversal for now. Let's say it's a retracement. So the next thing, when price retraces it, now took out this structural liquidity because this is a structural liquidity. Now takes it out. After it takes it out, the next thing you're going to do is the next after price takes out structural liquidity, what is the next move it should be? It should be a continuation, right? Whenever price takes out structural liquidity, the next move should be a continuation. So what will price do? The price will continue to the downside. And then when price continue to the downside, when it takes out this is now our transactional liquidity. When it takes out transactional liquidity, what is the next move? A retracement. So price start retracing. So now when price takes out so as price retrace, it's probably going to take out structural liquidity around this point. And once it takes out structural liquidity, the next move is structural liquidity. When price takes it out, the next move is a continuation. We have a continuation. Now this whole thing is going to keep on. So finally, when price now, so finally at this point, when price now takes out a structural transactional liquidity, the next move, as I told you guys, is either a retracement or an expansion or a reversal. So what price can do here is to either take out this structural liquidity and continue to the downside, or break this structure and we have a structural liquidity and we have a market structure shift. Now, if this doesn't make sense, once again, watch the video or just let me know, and I'll just tell me and it doesn't make sense. I'll make a well structured video with PDF that is going to make sense to you guys. But this should make sense. I took my time explaining it. Now, the same logic was how we come up with this tool that we posted in our free Telegram channel, right? So what we have here, we first try to identify our protected high, which is the high that swap liquidity. So the next thing we have is our structural liquidity. So we know that when price takes out structural liquidity, the next move is for the external range liquidity or the transactional liquidity. So when I saw this thing now, the next thing I'm looking to do is to buy from this demand zone. That obviously I didn't really take this trade because I was hoping to take it at this point. But as you can see, if you're looking for the following logic, you see it trades to this place and I continue to the downside. So after price even continue to the downside, now this is how we came up with this trade idea. But even what I'm still expecting is I'm expecting price to finally take out this transactional liquidity, which is also our external range liquidity. Once it takes it out, I want to see price come back down and take out this structural liquidity trading to this other block, then once again take out the external range liquidity. Okay, so my entry will be something like this around this point. That's my entry. Although this liquidity is far, but we also have this one liquidity at this point. So this is what I'm waiting for. This is what I'm waiting for. Why am I buying from this place? Why do I think? Why am I buying from this place? I'm putting my stop loss above this place because I believe that this swing high is protected. I believe that price is not going to take it out. Why? Because of its swept liquidity. It's it has been induced, right? What happened in this zone? What actually happened in this zone? This what happened here is smart money inducement. So what did? They created a fake move. They traded very close to the key level and started retracing. So as they started retracing, traders will be like, wow, this is um this is actually a good place to sell up. We should sell up from this other block because of this is this thing. But what price did here is this is actually a fake move that price created to induce traders, to lure traders to before price goes to the intended direction. So I hope you understand it. Let me give you more example. Which example should I give you guys now? If you go through the chart, you might be able to spot something. Okay, now guys, let's take a look at this. Let's take a look at this. So what do we have here? First thing, let's try to read market structure. Low, high, low. Okay, no, not yet low. So basically, all these things are a consolidation until price form something like this, then break structure. So from this place, let's try to mark our swing structure from this side. The first thing for you to mark your swing structure, the first thing you want to figure it out is your protected high. And this is actually the protected high because of price. This is where the inducement was formed, right? Price, this way price swept liquidity. So once again, let me try to explain this inducement. What the price did here, price traded high enough to the place and started retracing. So what traders are going to see when they see this move, they think that oh, let them buy at this zone, this other block. That price is already reacting off of this place and price spark down to take them out. So this is our protected high. Is that high that swept liquidity? And also not just it's a high as well liquidity and it has structural liquidity protecting it. Right, so these are swing high. Here is our protected high. I mean, so the next type of liquidity, these are protected high and these are external range liquidity, or we can call it as transactional liquidity. Now, what do we have here now? We have now what do we have here? We actually have our structural liquidity at this point. So when price takes out structural liquidity, the next drawn liquidity actually um the external of the range is to when price takes out structural liquidity, we are expecting a continuation. So when I saw this spice, just before this spice actually formed, I already once again this is a mist. Okay, yeah, okay, I think I took this trade. Yeah, I took this trade at this other block. It's not a mist setup. So when I saw this thing, I took my trade there, expecting price to take out this transactional liquidity and continue to take out this structural liquidity and continue to the transactional liquidity. And when price even take out this transactional liquidity, I'm expecting price to come back up, maybe form something like this. When it takes it out, I'm expecting price to form something like this and take this thing out and continue and just keep on doing our price action. So this is what I'm expecting. And so this is the catalyst to this trade, right? That's the reason why we took this trade. So I know this might sound rough. I didn't scripted the video well, but just watch it over and over again. If you don't understand it, let me know in the comment section. We have a very small audience, so I'm going to answer you guys. I'm going to reply to you guys. So yeah, I hope you guys like it. As always, it took me time and effort to make this video. I, I would really appreciate if you can like the video and if you also vibe with what I'm doing on this channel. Subscribe to the channel, guys, and I'm going to see you guys around. Remember what I talked to you guys about the mentorship. If that's the thing, if you have money, that's the only mentorship I suggest you go for. This is not just me, but this is the mentorship I wish I had. Why? Because of you are trying to replicate it. You are just following my footsteps. Yeah, so I hope to see you guys around.